All right, welcome to the Explainer. Today, we're going to pull back the curtain on a really cool accounting system. It's the tool that lets a huge global company figure out if that one little store in some small town is a total gold mine or just a money pit. You know, it's pretty much the secret to running a massive business empire.
Okay, let's kick things off with a little puzzle. Just imagine for a second, you're the CEO of a company with, 100 stores scattered all over the country. You've got money coming in, products flying off the shelves. But here's the real question. How do you actually know which of your stores are the rock stars and which ones are, secretly pulling the whole operation down?
Yeah, that right there, that's the multi-store mystery. And trust me, it's the kind of problem that keeps execs staring at the ceiling at 3 a.m. But, lucky for them, accountants came up with a pretty powerful solution.
And that solution is called branch accounting. So what is it? Well, at its core, it's a really simple, but honestly a game-changing idea. You basically treat every single one of your locations like its own mini-business inside the main company's books. And when you do that, boom, you get to see exactly how well each one is actually doing, with no place to hide.
So what this does is it sets up a really clear relationship. Think of it like this. You've got the head office, right? That's your command center, the central hub doing all the high-level accounting. And then you have your branches. They're the boots on the ground, the soldiers on the front lines, making sales and sending all their intel, their financial data, right back to headquarters.
Okay, so that's the big idea. But how does it actually work in the real world? Well, it's not a one-size-fits-all kind of deal. It's more like a mechanic's toolkit, you know? You've got different tools for different jobs.
Yeah, accountants have a bunch of different methods they can pull from this toolkit, and which one they pick, it really just boils down to two things. How big is the branch, and how much of a micromanager does the head office want to be?
So the simplest tool in the box, the one you see most often, is called the debtors method. The best way to think about it is like a quick peek at your car's dashboard. You know, it's not the full deep diagnostic from the mechanic, but it gives you that quick high-level glance to make sure the engine's not on fire. And it's called the debtors method because it basically lumps the entire branch into one single account, almost as if it were just one big customer, or a debtor.
And the logic behind it? It's beautiful. It's so simple. The head office literally just tracks two main flows. First, all the stuff it sends out to the branch. We're talking goods, cash for expenses, you name it. And second, all the stuff it gets back from the branch. And that's it. The difference between those two numbers, well, that's your profit or your loss. It's that straightforward.
And here's how that simple logic looks when an accountant lays it out. On the left side, the debit side, you're just listing everything that went to the branch, all the costs and assets. Then on the right, the credit side, you list everything that came back. So what happens when the two sides don't add up? Well, that single number you have to plug in to make them balance, that balancing figure, that, my friends, is your net profit or your net loss. It's like the final missing piece of the puzzle.
Okay, but what happens when that quick dashboard check isn't cutting it, right? What if you hear a weird noise from the engine and you think there's a serious problem? Well, for that, you need to pop the hood and run a full diagnostic. You need a much more powerful tool from that toolkit.
And that's where the stock and debtors method comes into play. This is the heavy-duty option. It's designed for those bigger, more important branches where the head office wants to see everything. We're talking maximum control, maximum visibility, and it does this by breaking things down into several super detailed accounts.
So the whole system kicks off with something called a branch stock account, and this account has one and only one job. It's like a bouncer at a club. It just tracks the physical movement of the goods, what came in the door and what went out the door. That's it. No money, no profit, just inventory.
Okay, now this is where it gets really clever. The next step is the branch adjustment account. This account is kind of magical. Its entire purpose is to mathematically strip out the built-in profit margin. Accountants have a word for this. They call it loading. So, by taking that loading out of the equation, the number you're left with, that final balancing figure, is the real gross profit. Pretty neat, huh?
And once you have that gross profit number, you just carry it over to the final stage, the branch profit and loss account. This is where you get down to the nitty-gritty. You take that gross profit and you start subtracting all the real-world operating expenses for that branch. You know, rent, salaries, all that stuff. And once you've deducted everything, the number at the bottom, that's your true bottom line net profit.
All right, quick heads up for any students watching this. Listen up because this next part is absolutely crucial. You have got to understand this loading concept, that profit margin. How you calculate it changes everything, and I'm telling you, this is the classic spot where exams love to try and trip you up.
Let's just walk through a quick example so it's crystal clear. Let's say an item cost the head office 100 rupees, okay?
Nice and simple. Now, they decide they want to make a 25% profit on that cost. So 25% of 100 is 25 rupees. Easy enough. So the final price on the invoice that goes to the branch is going to be 125 rupees.
But wait, here it is. This is the trap that gets everybody. That 25 rupee profit, it's 1/4 or 1/4 of the cost price, right? 100 divided by 4. But it's 1/5 of the final invoice price, 125 divided by 5. See the difference? Knowing which one of those fractions to use, that is the curveball that exams will throw at you every single time.
So, after seeing how incredibly detailed that stock and debtors method is, you're probably thinking, why wouldn't every company just use that one? It seems like the best, right? Well, the answer is pretty simple. It's all about trade-offs.
I mean, the advantages are undeniable, they're huge. You can find the exact profit or loss for every single location. That gives you ironclad control over your stock and cash. It gives you a super clear way to see which managers are doing a great job. And most importantly, it gives you the cold, hard data you need to make those massive, company-changing decisions.
But, and this is a big but, that kind of microscopic control isn't free, not by a long shot. It takes a ton of extra administrative work, which means more staff, more time, more money. Things can get really complex, like what happens to goods that are in transit between locations, and all that work of reconciling accounts takes forever. It can even, ironically, slow down the people at the actual branch from making quick decisions.
And that right there, that constant battle between cost and control, that really gets to the heart of why we're talking about this, which brings us to our final big takeaway. So, at the end of the day, why does any of this really matter? Why should you care about all this debiting and crediting? Because branch accounting isn't really just about balancing the books. It's about something much more powerful. It's about taking a giant mess of raw data and turning it into actual business intelligence. And you know what they say? Good intelligence always leads to good decisions.
This system gives CEOs the clarity they need to answer the absolute toughest questions. It screams at you, hey, this branch over here is a superstar, give it more money to grow. And at the same time, it looks you dead in the eye and tells you, without any emotion, that one over there, it's bleeding money. It's time to cut your losses.
So, we'll leave you with this final thought to chew on. Branch accounting is way more than just a bookkeeping chore. It's a fundamental strategic choice a business has to make. So put yourself in the CEO's chair for a second. The question you'd have to ask yourself is this: how much control do I really want? And, more importantly, how much am I willing to pay for?